The talks over raising the U.S. debt ceiling and lowering the deficit, they've all but monopolized Washington, and still no agreement has been reached. As we've reported, the impasse is already having an effect on the market. So what can investors expect as the August 2nd deadline nears? My next guest, Doug Dachille, is the co-founder and chief executive of First Principles Capital. He has more than 2 decades of experience managing assets for large institutions, and he still has all his hair. Well done, Doug. All right, that's an accomplishment in and of itself.
I may not have my hair by the end of the month.
Well, I was going to say, you've got,
but at least right now I have
time.
my hair.
There's still time to worry and have it all go great. August 2nd, a real deadline, or is this made up?
Well, I mean, it's quite interesting because if you think about how we got into this financial crisis, I mean, I think now the legislators are only beginning to understand all of the accounting mechanisms that were being done by financial institutions to try to avoid debt consolidation, to avoid regulatory limits and consolidation.
Because they're doing it themselves.
Right. Well, now I think what we're discovering is we don't have the same tools that the private sector had that we had in the public sector to figure out how to deconsolidate things. But the whole thing, it's fascinating because the reality is we have a $14+ trillion debt ceiling. But the reality is we have tons of non-consolidated debt, way in excess of this $14 trillion, whether we're going to raise it.
Sheet.
Right.
Fannie Mae, Freddie Mac, Social Security,
Medicare. Right. So we have all of these other issues. This is only the part that's actually on our balance sheet that we're focusing on right now. So the issue, and the other issue that you have to think about is, this issue is the debt that we're dealing with, if you're an individual consumer, is really like our credit card debt.
Right.
I mean, it's debt that we've taken out for which we've consumed. It's not debt that we've actually taken out for which we have an investment. Because when you have debt that you take out with consumption, for consumption purposes, nothing can pay it back other than your hard earnings. But if you have debt like a mortgage, which you take out, for which you actually have an asset, there is at least some positive probability that the asset has the ability to repay the debt.
Right. There's some income generation associated with the debt that you've taken out. You build a factory, it produces goods.
Right. You have a loan. I mean, there's a number of things on which is interesting because the government really hasn't bifurcated the debt. There are a number of things on the balance sheet for which we've issued debt, which actually are assets. For example, we've now taken over the student lending business, the direct student. So there's an asset there. Now, do I think 100% of those loans will repay? No, but certainly, should we really be considering, where we do have explicit assets, should we be considering dollar for dollar the liability that was issued when there is an asset supporting the liability?
But and you're just describing the situation, which is on a technical basis, there is almost no way to follow the breadcrumb trail of borrowing the money and where the money went. So on a household basis, you would look at your debt and you would say, all right, where did we spend this? How can we cut back? What can we do? There isn't even that ability in the government right now.
Right. Well, I mean, you raised an interesting point about Fannie and Freddie not being consolidated. Well, to my point, at least for the most part, if we were to consolidate the liabilities, like ignoring the guarantees, the debt that they've actually issued, at least for the most part, they have assets against those debts.
Right, they've got mortgages,
Right,
houses.
they actually have assets. The problem we have with the debt ceiling that we're dealing with today is we don't really have a lot of assets. It's not like we could sell something to try to bring down the debt to actually satisfy.
We'd have to sell something completely disintermediary, right? That's a big word.
Absolutely.
But I mean, we'd have to sell something that bears really no connection with the specific debt that we've incurred.
And the other interesting thing, which many investors aren't thinking about the consequences of, is the consequence of, if we do have a shutdown, what will actually happen to entities like Fannie Mae and Freddie Mac? Because right now, they're under the conservatorship of the federal government, and the federal government has an obligation to purchase preferred shares to satisfy and keep it at positive net worth. What happens if the federal government doesn't increase the debt ceiling, and there's a need for additional purchases of preferreds? What would be the implications of that?
So do you think that they're going to get to this August 2nd deadline and do something, or is it really going to be a situation where, as I've heard many lawmakers describe, oh, well, the sun will still come up on August 3rd?
Right. I mean, there's a general, the thing that's most worrying is that I think there's a general complacency that'll get resolved, which is always a bad thing. The most important thing to get anything resolved is to have a sense of fear. Fear is always the best motivator. And actually, I'm more worried that there is a general complacency in the markets, in the pricing of debt, in agency debt, treasury debt, mortgage debt. There's a general complacency that something will be done, which is always a bad situation when you're coming up to a deadline.
Is it also that we're complacent when it comes to the level of interest rates? And that's going to lead lead us into our next segment, because even though interest rates are now very low, a small increase will have a mathematically important effect on the amount that we have to pay every month in interest.
Right. I mean, that's another interesting issue, because the signals to the legislators are poor. I mean, we're not getting the right type of biofeedback to motivate, because you look at the level of interest rates and you would think that there's not a problem. What do I have to solve a debt-related issue? The biofeedback coming from the rates market is not giving a clear signal, partly because we have crises taking place in Europe, partly because we have the Federal Reserve buying the debt.
Doug Dachille, let's talk about interest rates and the connection between the cost of money and mortgages. Hasn't helped the mortgage industry, has it?
No, I mean, we've talked about this a number of times, that it's not a rate problem, that solving the housing market today is not about getting rates lower. You could drive the rates another 1 or 2% lower, and it still wouldn't have a material consequence. And it all is about the process of taking out a mortgage, the process of refinancing a mortgage. Basically, what's happened is we went from one extreme, which was abused, to a complete other extreme. Now, the concept of a streamlined refinance or a streamlined mortgage process is a complete oxymoron. It's not possible. We've gone from a situation where you could go and people abused it, providing stated income. Well, now there's no such thing as stated income. Now you have to provide a 1040, whereas we all know nobody ever overstates their income on a 1040. But even more than that, they now go look at line item by line item component, to the point where the process is virtually impossible to take out a loan. So you could lower the rate, but you still won't help the housing market, because people won't qualify. The process will be so onerous that people will just fall out of the pipeline in the process. So it's not about the rate, it's about the process. And the question is, that's going to be a legislative matter, not one that can be solved by the Federal Reserve.
Is it possible, though, that if banks somehow manage to raise the rate on the mortgage and then said, all right, we will really streamline the process, but you are now going to have to pay for that streamline?
No, it's not the banks. And a lot of people are pointing fingers at the banks, that it's the banks that are. It's actually the government.
The regulators.
It's Fannie Mae and Freddie Mac have created, in their response to what happened, they have now gone the other way. They are extremely conservative, requiring documentation to the unnecessary, useless documentation, which really has no material bearing in an underwriting of a mortgage. But they're going to require that. And if you don't check the box and have each of those items on the checklist of what they require to execute the mortgage, you know what happens? The bank is forced to do a buyout of that loan. And no bank wants to do a buyout of the loan. So you're in a situation where the documentation requirements of the agencies have gone off the charts. Banks are so fearful, they don't want, even if you ask questions, why do I need to provide that? They don't want to answer that question. They just say because the agency's required. So we're actually in a situation where one side of the government is trying to help the mortgage market, yet the government itself is precluding the ability to help the housing market because of what's going on at Fannie Mae and Freddie Mac right now in terms of documentation. And so there's no solution to that problem unless there's legislative involvement, which there are a number of bills that are on the table right now to consider establishing more streamlined refinancing opportunities so people can actually convert it back to a rate phenomena, not a process phenomena.
So what's the likelihood that we get any action on the legislative front?
Well, we started out our
with
conversation.
The debt ceiling.
We started out our conversation on that in terms of, well, the interesting thing is, from a perverse perspective, if you actually had a situation where you didn't increase the debt ceiling and you had a Fannie Mae situation, Fannie Mae and Freddie Mac were in need of additional capital through their preferred, you might have a situation where then you can actually solve the debt ceiling problem and the Fannie Mae and Freddie Mac.
At the same time.
Right.
But that seems a little far-fetched. I mean, come on.
I mean, ironically, I would argue, just from a contrarian perspective, since lowering rates hasn't really achieved the desired objectives, I could make an argument that I could see positive benefit out of increasing rates.
What would happen?
Well, we know that lowering rates was designed to help homeowners and borrowers. Well, they're not able to avail themselves of the lower rates. But we do know a set of parties in America that are actually being penalized because of the low rates. Those are people who actually live on fixed income and invest in low-risk investments and who live off the interest rates that they earn on their investments. Those people indisputably are getting hurt by having
someone who's got a CD, for example, right? A certificate of deposit, if the rate went up. They could actually then have more money. They could actually pay their mortgage.
Right. Well, even worse, you have people who are living on that income. And to the extent that that income, they have maturing CDs, they have maturing investments, they're watching their interest earnings go down. What are they going to do? They're going to join the workforce to get a job and be on the job line, competing with all the other people that are on the job lines now. So I could make a very good argument that, well, it hasn't worked lowering the rates.
So maybe raise them and see what happens. As always, a pleasure. Very provocative. Doug Dachille, First Principles Capital Management.